So if a massive publicly traded company beats Wall Street's earnings expectations by, a penny or two, the market usually just gives them a polite round of applause.
Right, maybe a slight bump.
Yeah, exactly. Maybe the stock bumps up 1%. But when a company beats its own internal profit projections by almost 50 cents in a single 90-day window.
That's just wild.
It really is. I mean, Wall Street drops its collective coffee mug. Analysts scramble. It is basically the financial equivalent of an earthquake because, well, it signals that the incredibly sophisticated models everyone uses to predict the future are fundamentally broken.
Or, that the company has just unlocked a level of efficiency that literally no one thought was possible.
Right. And today, we are looking at a quarter that absolutely broke the models.
Because, it is really rare to see a miss of that magnitude in the positive direction, especially in an industry that is scrutinized down to the decimal point.
Oh, absolutely.
You're usually looking at layers upon layers of adjusted earnings and forecasted headwinds and statistical noise. It makes it very difficult to see the underlying machinery. But this particular quarter cuts through all that fog. It gives us a really clean, undeniable look at the mechanics of a turnaround.
And that is exactly why we're bringing you a special edition of our deep dive today. We're sort of channeling our Talk Tickers persona for this one.
Oh, yeah.
Our mission is to decode a massive, highly complex earnings call specifically for you, the retail investor.
Right.
You're putting the Centene Corporation, ticker symbol CNC, right under the microscope, and we're looking at their Q1 2026 earnings call.
We're operating with a very specific framework today, too.
Right.
The analysis is going to be aggressively data forward. We are going to take a definitive, opinionated stance on what these numbers actually mean. We want to give you actionable insights for your portfolio. And perhaps most importantly, we are keeping this in strictly plain language.
Because, man, the healthcare and finance sectors love their jargon.
They really do. They just hide behind acronyms. So we are going to take all of that institutional speak and translate it into a comprehensive masterclass on Centene's current financial health.
Just to make sure we're all starting from the exact same baseline, let's establish what Centene actually does. This is a behemoth in the managed care space. They provide health insurance programs, but they are uniquely focused on government-sponsored healthcare.
Right. They aren't the company your employer typically uses for corporate benefits.
Exactly. Instead, they operate three massive, distinct pillars. So you have Medicaid for underinsured and low-income families, Medicare for seniors, and the commercial marketplace, which most people know as the Affordable Care Act or Obamacare exchanges.
And they sit at one of the most complicated intersections in the American economy. They act as the intermediary between state and federal governments, healthcare providers, and millions of vulnerable patients.
Huge undertaking.
It is. They're tasked with managing billions of taxpayer dollars and individual premiums. So their entire business model hinges on this really delicate balancing act.
Yes.
Trying to suppress the ever-rising cost of medical care while simultaneously ensuring that their members actually get the treatments they need. And all while generating a return for their shareholders.
Okay, let's unpack this because we really have to start with the sheer scale of the headline numbers here. Centene reported revenue of $44.7 billion for just the first quarter of 2026.
Which is staggering on its own.
It is. But revenue is just top-line volume. The number that caused that Wall Street earthquake was the bottom line. They reported an adjusted diluted earnings per share, or EPS, of $3.37.
And to put that into perspective, that $3.37 EPS was nearly 50 cents better than the guidance their own management team had set. Yeah. When an insurance company models their quarter, they have massive actuarial teams running predictive algorithms on, how often people will get sick, what the weather will be like, and how many prescriptions will be filled.
Right.
So beating those internal models by 50 cents means something fundamental within their operation performed radically better than the historical data suggested it would.
So to figure out how they pull that off, we have to look at the master metric of the health insurance industry. Centene reported a consolidated HBR of 87.3%.
Right, the all-important HBR.
Yeah. Now, we promised plain language, so let's lock down this concept immediately because it drives literally everything else we're going to talk about today. What is an HBR, and why is an 87.3% such a powerful number here?
So HBR stands for Health Benefits Ratio. You might also see it referred to in financial filings as the medical loss ratio, or MLR. but the math is identical.
It's the exact same thing.
Yeah, exactly. It is the absolute most critical, vital sign for any health insurer. The HBR represents the percentage of premium dollars the insurance company actually spends on clinical medical care and direct quality improvements for the patients.
Okay, let me try to put this in everyday terms. Imagine you're putting together a massive wedding, and you hire an event planner with a strict $100 budget.
Okay, I like this.
The HBR is basically a contractual rule that dictates how much of that $100 the planner must spend on the actual party. So the catering, the band, the venue, that is the medical care in this scenario.
Right.
If the HBR is 87.3%, it means the event planner spent exactly $87.30 on the party itself.
That analogy works perfectly, but we have to look at what happens to the remaining $12.70 out of that original $100 premium.
Right, the leftovers.
Yeah. That leftover slice of the pie is what the insurance company uses to fund its entire corporate existence. They use it to pay their employees' salaries, keep the lights on in their office buildings, and, invest in new technology.
And in financial terms, we call that SG&A, right? Yeah. Selling, general, and administrative expenses.
Exactly. And whatever tiny sliver of money is left over after all those administrative bills are paid, well, that becomes their profit margin.
So the golden rule of managed care is brutal but simple. The lower the HBR, the more profitable the insurance company is, as long as they aren't violating state regulations by withholding necessary care, obviously.
Right, there's a floor.
Yeah. So an 87.3% HBR across a $44.7 billion consolidated business is a masterclass in efficiency. They kept the cost of the quote-unquote party slightly lower than anyone modeled, which left a massive pool of capital to drop straight down to that $3.37 earnings per share.
But, an aggregate number like that can hide a lot of internal turbulence.
Oh, for sure.
This outperformance wasn't just a rising tide lifting all boats. It was heavily concentrated in specific operational victories. To truly evaluate if Centene is a smart play for a retail investor, we really have to dissect that HBR.
Break it down by parts.
Exactly. We need to look at the story behind those numbers, segment by segment, starting with their historical bread and butter.
And that brings us to Medicaid. This is the foundation of Centene. They built their empire by managing state Medicaid programs. Now, in Q1, they reported 12.4 million Medicaid members.
Which is a huge number.
It is, but that number is actually slightly down from the end of 2025. Management was very quick to point out that this was completely expected, though, due to the ongoing wave of post-COVID redeterminations.
We really need to pause and explore the history of redeterminations, because it has been the biggest macroeconomic headwind in the managed care space for the last 3 years.
Yeah, let's get into that.
So when the pandemic hit in early 2020, the federal government declared a public health emergency. As part of that, they offered states enhanced federal funding, but with one massive string attached.
What was the string?
The states were legally prohibited from kicking anyone off the Medicaid rolls, regardless of whether their income had gone up.
So for roughly 3 years, the normal churn of the insurance market just froze.
It literally froze.
Like someone might have been on Medicaid in 2020 because they lost their job, found a great new job with corporate benefits in 2021, but they still technically remained on the Medicaid rolls because the state wasn't allowed to process the paperwork to remove them.
Right. The rolls just swelled to unprecedented, bloated levels.
That is the exact setup. Then the public health emergency ended. The federal government mandated that states had to go back and, quote unquote, redetermine the eligibility for tens of millions of people.
And this process, often called the unwinding, was a logistical nightmare.
Oh, I bet.
Yeah. Medicaid populations are often transient. Mail goes to old addresses. People don't respond to forms. So states had to manually process years of backlogged eligibility checks.
So when Centene says their membership is slightly down, it's because this massive, multi-year unwinding process is finally normalizing. They're losing the people who no longer qualify, which shrinks the total pool of members.
Exactly.
But here is the wild part. Even with a shrinking membership base, the profitability of that Medicaid segment surged. Their Medicaid HBR came in at 93.1%.
That's impressive.
It really is. That is an improvement of 50 basis points, so half a full percentage point, compared to the same quarter last year.
And in the context of a program that covers 12.4 million people, A 50 basis point improvement equates to hundreds of millions of dollars in saved medical costs.
Hundreds of millions.
Yeah. Management pointed to a trifecta of drivers for this. First, they experienced a much lighter flu season than their actuaries originally modeled. Second, mild weather across the country slightly depressed hospital visits. People aren't slipping on ice or getting into as many weather-related car accidents.
Makes sense.
But the third driver is the one investors really need to focus on: a highly aggressive, systemic crackdown on fraud, waste, and abuse, or FWA.
Let me stop you right there because I have to push back on the first 2 points.
Okay, go ahead.
If management is openly admitting that a good chunk of this massive Q1 outperformance came from a lighter flu season and nice weather, how is that an actionable thesis for an investor?
That's a fair question.
Right. Because you can't build a long-term portfolio strategy on the hope that the weather stays pleasant and the flu virus decides to take a gap year. If this HBR improvement relies on luck, it's not sustainable.
Your skepticism is entirely warranted, and frankly, it is the exact same skepticism Wall Street analysts directed at CEO Sarah London during the Q&A portion of the call.
I'm glad I'm not the only one.
No, not at all. Yes, the weather and the flu were incredibly helpful tailwinds. But the operational changes, specifically the FWA crackdown, are permanent structural upgrades to how Centene does business.
Okay.
To understand this, we have to look at the concept of net trend.
Let's define that. Trend is the insurance term for how fast medical costs are naturally rising, right?
Correct. Gross medical trend is the natural trajectory of healthcare inflation. Hospital prices go up, new expensive machines are invented, and, the population gets older.
Right.
Centene is constantly trying to wrestle that growth trend downward. Net trend is the final number. It is the underlying rise in medical costs minus all the financial savings Centene generates through their own management initiatives.
So like negotiating tougher contracts with hospitals.
Exactly. Or, in this case, stopping fraud.
Got it. Management stated they're targeting a mid 4% range for that net trend for the rest of the year. Yeah. And because Medicaid is a state-level program, the states evaluate how much healthcare costs are rising and update the premiums they pay Centene accordingly. Currently, Centene is seeing composite rate yield increases from the states of around 4.5%.
And the math there is the definition of stability. If your internal costs are growing at roughly 4.5% and the state governments increase your funding by 4.5%, your profit margins remain perfectly intact.
They match up perfectly.
Right. But Centene didn't just maintain their margins in Q1, they expanded them. And a massive piece of that puzzle centers on their crackdown on behavioral health costs.
This was easily the most vivid part of the entire earnings call. Sarah London highlighted an intense focus on applied behavioral analysis, or ABA therapy.
Yes.
Over the last year, Centene has been hoarding data across their network, using it to build profiles of outlier providers. They aren't just looking for accidental billing errors. They're hunting for clinics that are exhibiting highly suspect, mathematically impossible billing patterns.
The examples are just staggering when you look at the raw data. They identified behavioral health providers who were systematically billing for the absolute maximum allowable hours of therapy for every single patient on their roster, every single week of the year.
I really want to paint a picture of what that actually means. Imagine an algorithm flagging a clinic because, to justify the bills they submitted, a single human therapist would have had to work 28 hours a day.
Which is impossible.
Right. 28 hours a day, 7 days a week, without taking a single bathroom break.
Yeah.
It is statistically and physically impossible for a clinic to operate at that theoretical maximum without outright fraud or, gross excess utilization occurring.
Exactly.
Centene isn't just randomly auditing doctors. They're using data to stop obvious mathematical impossibilities from draining the taxpayer system.
And by aggressively stamping that out, by simply refusing to authorize or pay those fraudulent claims, Centene instantly yanks their medical costs downward. But the most important development here is that Centene isn't fighting this battle alone anymore. The states themselves are waking up to the drain on their budgets and are taking direct, punitive action against these providers.
So the state governments are actually stepping in to revoke licenses rather than just relying on the insurance company to deny the claim.
Exactly. A state attorney general or health department suspending a fraudulent provider's license is a permanent systemic fix to the medical cost trend.
That's huge.
It is. And Centene is weaponizing its massive scale to help. Because they operate in 30 different states, their data systems can track a bad actor who gets caught and kicked out of the Texas Medicaid program, only to cross state lines into Oklahoma, hang up a new shingle, and try to run the exact same scam.
Oh, wow.
Centene's network can see that migration pattern and block them immediately.
See, that makes the margin improvement story infinitely more believable. The flu season is a lucky break that might reverse next winter. But a state-backed, data-driven system that catches fraudulent billing before the check is even printed, that worked 365 days a year, regardless of the weather.
Right. It creates a fortress around their Medicaid margins. And they are going to need that stability because as we transition away from the state-funded Medicaid business, we have to look at their federally influenced Medicare segment.
Oh boy, Medicare.
Yeah. And the regulatory ground under the Medicare market is violently shifting right now.
I think violently shifting might actually be an understatement. Let's dive into the Medicare story. In Q1, their Medicare HBR came in at 84.9%, which, much like the consolidated number, was better than they or the street anticipated.
Right.
But the underlying dynamics of this population are incredibly complex. They split their Medicare business into two primary buckets: the prescription drug plan, or PDP, which has about 8.7 million members, and the Medicare Advantage, or MA business.
And within that Medicare Advantage portfolio, management highlighted a critical demographic data point. 40% of their MA membership is now classified as DSNP.
Okay, we are drowning in acronyms again. Let's clear this up for everyone. PDP is straightforward. It's a standalone insurance policy that only covers prescription drugs for seniors.
Yes.
Medicare Advantage, or MA, is the alternative to traditional government Medicare. A senior chooses to have a private company like Centene package all their benefits together: their doctor visits, hospital stays, and usually their drugs into one managed plan.
Correct.
What is a DSNP, and why does it matter so much that it makes up nearly half of their portfolio?
So DSNP stands for Dual Eligible Special Needs Plans. The dual eligible part is the key here. These are individuals who are in a uniquely vulnerable financial and medical position.
Okay.
They qualify for Medicare usually because they are over 65, but they simultaneously qualify for Medicaid because they fall below the poverty line.
So you are dealing with a population that often has complex, compounding chronic illnesses combined with significant social determinants of health, things like food insecurity or lack of transportation.
Precisely. Managing a DSNP population requires highly specialized intensive care coordination. You can't just hand them an insurance card and hope for the best.
Right, they need active help.
You have to actively manage their care. However, if an insurance company can build the infrastructure to care for these members effectively, DSNP populations tend to be incredibly sticky.
Sticky.
Yeah, they don't switch insurance plans every year, and the government pays higher premium subsidies to account for their complex needs.
But regardless of whether a member is standard Medicare or DSNP, Centene, and frankly the entire American healthcare sector, is slamming headfirst into a massive crisis, which is pharmacy trends.
Oh, yeah.
The cost of prescription drugs, particularly high-end specialty drugs, is going absolutely parabolic. And this is entirely tied to a major piece of federal legislation called the Inflation Reduction Act, or the IRA.
We really need to set some strict boundaries here.
Good idea.
The IRA is a highly politicized piece of legislation. As analysts, we have to strip away all the political discourse and evaluate the IRA purely objectively through the lens of corporate mechanics and behavioral economics.
Absolutely. No taking sides, just the data.
Right. The legislation instituted sweeping changes, but the provision causing the most immediate turbulence for insurers is the new $2,000 annual cap on out-of-pocket prescription drug costs for Medicare members.
So to really understand how a simple cap blows up an insurance company's financial model, we have to split the Medicare membership into two groups, right? LIS and non-LIS.
Exactly.
LIS stands for low income subsidy. These are members who, historically, already received massive financial help from the government to pay for their drugs. The new $2,000 cap doesn't really change their behavior because they were rarely paying anywhere near that amount anyway.
Right. The disruption is entirely driven by the non-LIS members. These are standard income seniors who, prior to the IRA, were exposed to the brutal reality of specialty drug pricing.
Right.
If they needed a complex medication for rheumatoid arthritis or cancer, they might have been responsible for a percentage of that cost, which could easily amount to $10,000 or $15,000 a year out of their own pockets.
Let's walk through a simulation of this because the behavioral shift is really fascinating. Let's imagine a patient, well, we'll call him the $10,000 a month patient.
Okay.
He needs a high-end specialty drug. Prior to this legislation, the sheer terror of coinsurance might have forced him to ration the drug, seek cheaper, less effective alternatives, or, skip it entirely because it would literally bankrupt him.
But under the new IRA mechanics, that patient's world changes. In January, he fills his prescription, he pays his share, and within maybe 2 months, he hits that absolute legal cap of $2,000.
And then what?
For the remaining 10 months of the year, he is completely shielded from the financial burden of that drug. The medication is essentially free to the patient from March through December.
From a patient advocacy standpoint, that is life-changing. But from an insurance actuary standpoint, it is a nightmare.
A total nightmare.
Utilization of incredibly expensive drugs skyrockets because the financial barrier to entry has been removed. And as Centene CFO Drew Asher pointed out on the call, the pharmaceutical companies are fully aware of this new dynamic.
Yes. Asher made a very sharp observation about market incentives. Pharmaceutical manufacturers realize that once a patient hits that $2,000 threshold, the patient no longer cares what the sticker price of the drug is.
Right, because they aren't paying it.
Exactly. The manufacturer can raise the price of the specialty drug knowing it won't impact the patient's demand, which removes almost all the natural downward free market pressure on drug pricing.
Which means Centene is left holding the bag. The patient pays their $2,000, and Centene has to cover the remaining, $118,000 for the rest of the year?
Essentially, yes.
This dynamic is driving specialty drug costs to historically high levels across the entire insurance industry. Now, to management's credit, they saw this storm coming. They built highly conservative utilization assumptions into their 2026 forecasts, and their Q1 HBR beat suggests that while the costs are high, they aren't quite as catastrophic as their worst-case internal models predicted.
But weathering the storm for one quarter doesn't solve the long-term structural problem.
No, it doesn't.
An insurance company cannot survive indefinitely if utilization of its most expensive liabilities is artificially untethered from price. Management was heavily pressed on this during the call. Their response was that they have a clear path to break even in the Medicare segment by 2027.
How do they get there, though? If the law caps the patient's cost and the pharma companies won't lower the price, how does Centene stop bleeding money?
By rewriting the rules of engagement with the federal government. The entire Medicare Advantage program is funded by the Centers for Medicare and Medicaid Services, or CMS. CMS pays Centene a set amount per member per month based on a massive, complex risk adjustment formula.
Okay.
The problem is that the current CMS payment formula was calibrated using historical data from before the IRA went into effect.
So the government's model is essentially lagging behind reality. It doesn't fully recognize how expensive these non-LIS patients have actually become.
Exactly. The model hasn't digested the spike, but as the 2026 claims data solidifies, that higher utilization becomes an undeniable statistical fact.
Right.
Centene is currently in the process of raising their bids for 2027. They expect that the CMS direct subsidy, the actual baseline funding the government provides to the insurer, will have to increase significantly in 2027 to reflect the new IRA-induced reality of pharmacy costs.
So they're essentially taking a hit now to gather the empirical data needed to force the government to write a larger check next year.
That's one way to look at it, yes.
But here is where it gets really interesting, because Sarah London isn't just sitting in her office waiting for a federal bailout. They are actively deploying new clinical strategies to mitigate these costs, specifically through value-based care models.
Value-based care is the holy grail of modern health insurance, but it is incredibly difficult to execute.
So difficult.
Management highlighted that they are deploying total cost of care models targeted specifically at high-cost, high-acuity medical conditions like oncology for cancer patients and chronic kidney disease.
Let's break down the difference between the traditional model and value-based care. Historically, the system operated on fee-for-service. A cancer patient goes to the oncologist runs a test, they bill Centene $500.
Right.
They do a chemo session, they bill Centene $2,000. The doctor's financial incentive is to do as many procedures as possible, regardless of the overall outcome.
Yes. Under a value-based total cost of care model, Centene approaches a high-performing oncology group and changes the financial arrangement entirely. They agree to look at the total expected cost of treating a patient's cancer for a year. If the oncologist provides superior proactive care that prevents the patient from ending up in the emergency room with severe complications, the overall cost of care drops.
Makes sense.
Centene then shares those financial savings directly with the doctors as a bonus.
It aligns everyone's incentives. The patient gets better, more attentive care to keep them out of the hospital. The doctor makes more money by keeping the patient healthy rather than just running tests.
Right.
And Centene significantly reduces the catastrophic hospital bills that destroy their margins. It is a long-term structural play to return the Medicare segment to sustain profitability by integrating clinical execution directly with financial management.
It's a very impressive strategy. But, while Medicare and Medicaid rely heavily on government negotiations, Centene's third pillar requires them to navigate the chaotic waters of consumer choice.
The open market.
Yeah. We need to transition to the commercial segment, the Affordable Care Act marketplace. And I want to caution everyone listening, the mechanics we are about to discuss are some of the most complex, counterintuitive concepts in corporate finance.
It really requires some serious mental gymnastics to understand. But for a retail investor, this segment is crucial because this is where the biggest potential upside for Centene stock might be hiding in plain sight.
Absolutely.
Let's start with the baseline. Centene ended Q1 with 3.58 million commercial marketplace members.
And the defining macroeconomic event for the marketplace in 2026 was the expiration of the EAPTC, the Enhanced Advance Premium Tax Credits.
Right.
To understand consumer behavior this year, we have to look back at what those credits actually did. Congress had previously passed enhanced subsidies that essentially made your marketplace insurance artificially cheap or, in many cases, completely free for millions of Americans.
The government was heavily subsidizing the monthly premiums. But when those legislative enhancements expired, reality came crashing back down. The cost of insurance suddenly spiked for the consumer. And when things get expensive, consumers change their behavior.
The overall market naturally contracted as some people simply dropped coverage. But for the millions who needed to stay insured, Centene witnessed a massive migration across the metal tiers.
Ah, the metal tiers.
Yeah. Marketplace plans are categorized by metals: bronze, silver, gold, and platinum. Bronze plans are the cheapest option. They have very low monthly premiums, but the patient faces massive out-of-pocket deductibles if they actually need to go to the hospital.
Right.
Silver plans are the middle ground, balancing moderate premiums with moderate deductibles.
Because the premium cost suddenly spiked without the government tax credits, healthy consumers looked at their budgets and abandoned the silver plans en masse. They downgraded to the cheaper bronze plans. They essentially gambled that they wouldn't get sick, so they took the lowest possible monthly payment just to maintain baseline coverage.
But a specific demographic of people did not downgrade to bronze. And this is where the concept of the acuity shift becomes paramount.
Acuity, let's define that.
Acuity, in medical economics, is a measurement of how sick a patient population is. The members who looked at the higher prices but actively chose to remain in Centene's and better silver plans were, on average, a much higher acuity population.
So they were sicker. They were the people who knew they had diabetes or a heart condition or like upcoming surgeries. They knew they needed regular expensive medical care, so they were willing to swallow the bitter pill of a higher monthly silver premium because they needed the better clinical coverage that came with it.
And the immediate localized result of that demographic shift is exactly what you would expect. Centene's gross medical costs in the silver tier spiked in the first quarter. They were left insuring a concentrated pool of sick people who are aggressively utilizing their medical benefits.
Okay, I'm going to stop you right here. I'm looking at this dynamic and I am thinking, isn't this the textbook definition of an insurance death spiral?
It sounds like it, doesn't it?
Yeah. If all the healthy young marathon runners who never go to the doctor abandon your plan for a cheaper competitor, and you are left exclusively with the sickest patients who consume massive amounts of medical resources, your costs go through the roof.
Right.
To cover those costs, you have to drastically raise your premiums next year. That price hike forces even more moderately healthy people to leave, leaving you with an even sicker pool. The math eventually implodes. So why was Centene's management team acting so remarkably calm about this on the call? Why are they treating this concentration of sick patients like a strategic victory?
That is the exact logical conclusion if you apply traditional free market insurance rules to this scenario.
Yeah.
But the ACA marketplace does not operate on traditional rules.
Okay, how so?
To understand management's confidence, we have to explain the golden rule of risk pools. The Affordable Care Act was explicitly engineered by policymakers to prevent the exact death spiral you just articulated. They created a stabilizing mechanism called risk adjustment.
Okay, I've heard this term thrown around constantly. What is the actual mechanic of risk adjustment? How does it save an insurer from going bankrupt when they end up with all the sick patients?
Risk adjustment is a massive, incredibly complex financial balancing act orchestrated by the government behind the scenes of the open market. It evaluates the aggregate health status, usually measured as a risk score, of every single person who buys insurance in a specific state's marketplace.
Let's use a hypothetical. Let's say insurance company A launches a really flashy marketing campaign and manages to attract all those healthy 25-year-old marathon runners.
Okay.
They collect all those monthly premiums, but their medical payouts are practically zero because nobody gets sick. They look wildly profitable. Meanwhile, insurance company B, which in our case is Centene, ends up covering all the 60-year-olds with chronic illnesses. Their medical payouts are astronomical.
If the story ended there, Company B would go bankrupt, just as you said. But risk adjustment levels the playing field retroactively. At the end of the year, the government looks at the data and essentially says, Company A, you only achieved those massive profits because you got incredibly lucky and didn't have to insure any sick people.
Right.
Company B took on the societal burden of actually caring for the chronically ill.
And then the government forces Company A to write a massive check to Company B.
Exactly. The risk adjustment mechanism literally confiscates revenue from the plans with the unusually healthy members and transfers it directly to the plans with the unusually sick members.
Wow.
Therefore, in the ACA marketplace, adverse selection is not a death spiral. In fact, if your actuaries price your plans correctly, actively caring for a higher acuity, sicker population can actually be a highly lucrative strategy because you receive these massive, multi-million-dollar risk transfer payments to compensate you for the higher medical costs you incurred.
So Centene is seeing higher gross medical bills today in Q1, but they are completely unbothered because they know the mathematical formula of the ACA is going to force their competitors to hand them a giant bag of cash later in the year to offset those early losses.
That is the strategy. But historically, this was a massive gamble. Insurers wouldn't know the final math. They wouldn't know if they were getting a check or writing a check until the government released the final data late in the year.
That sounds stressful.
It created massive earnings volatility.
But management indicated they aren't flying blind anymore. They specifically cited something called the Wakely data. What is Wakely, and how does it give them an edge?
So after suffering through incredible volatility in the marketplace last year, the insurance industry did something highly unusual. They collaborated. Competitors like Centene, Elevance, and others agreed to submit their early, anonymized membership demographics to an independent actuarial firm called Wakely.
Wait, isn't that essentially colluding on market data?
Not at all. Wakely acts as a neutral clearinghouse. They blind the data so no one sees their competitors' specific proprietary secrets.
Ah, okay.
It's akin to playing a high-stakes poker game, but midway through the hand, everyone agrees to show their cards to the dealer. And the dealer quietly tells you whether your hand is stronger or weaker than the average of the table before the final bets are placed.
That is a massive informational advantage. Wakely aggregated the data across 29 different states, and the report came back confirming Centene's internal hypothesis. It empirically validated that across the entire market, there was a massive consumer shift down to bronze plans.
Right.
Most importantly, it confirmed that Centene did, in fact, retain a disproportionately higher acuity, sicker silver population relative to their competitors.
Armed with that independent data, combined with their own internal claims tracking, Centene's finance team made a definitive accounting move. They announced they are now officially booking a slight receivable for risk transfer in their Q1 numbers.
Meaning, they are formally telling Wall Street, we forecast that we will be receiving money from the risk pool rather than paying into it.
Exactly.
But this is where the actionable insight for the retail investor really takes shape. Because despite having this data, Centene's management is playing their cards incredibly close to the vest. CFO Drew Asher stated on the call that they felt it was, quote, prudent to embed a pre-tax margin for the marketplace of around 3% for the time being.
Which is actually a downgrade from their original pre-year forecast of a 4% margin. But the key word to focus on is prudent.
Prudent.
Sarah London explicitly warned analysts that their current financial guidance does not reflect the full potential risk adjustment offset that the Wakely data suggests they are owed.
They are deliberately holding back. They have a report suggesting a massive payday is coming, but they are refusing to bake it into their official earnings guidance until the final government-mandated June Wakely data release occurs. That June release will include actual, finalized claims and risk scores across the entire ecosystem.
If that June data corroborates what the early read suggests, there is a massive hidden upside offset waiting to detonate in the back half of the year. That conservative 3% margin assumption could easily spring back to 4% or higher.
In a multi-billion-dollar segment, a 1% margin expansion drops an enormous amount of pure profit straight to the bottom line.
And if we step back and look at the psychology of the leadership team, it paints a very clear picture. You have a management suite that is prioritizing stability and predictability over flashiness.
Right.
They have the mathematical evidence to suggest a windfall is coming, but they are choosing to absorb the scrutiny of a conservative guide today, ensuring that when the data is finalized, they can deliver an undeniable upside surprise to the market later.
Which serves as a perfect transition to the broader financial picture. Despite playing it so conservatively on the marketplace risk adjustment, the strength of their underlying operations forced them to raise their full-year guidance anyway. But let's look at how all these pieces roll up into their view for the rest of 2026.
The guidance updates were unequivocally strong. They officially raised their full-year adjusted EPS guidance from a baseline of greater than $3 to a new baseline of greater than $3.40.
Solid bump.
Yeah. They also added $1 billion to their total premium revenue forecast, which management noted was largely driven by unexpected outperformance in their Texas Medicaid contracts.
We also have to highlight that they guided their SG&A ratio, those administrative costs we discussed earlier, downward. That means they aren't just growing revenue, they are simultaneously operating a leaner, more cost-efficient corporate structure.
But the most fascinating part of the financial discussion wasn't the revenue guidance. It was a seemingly obscure balance sheet maneuver buried in the CFO's remarks that was an absolute masterclass in capital deployment.
Oh, the factoring move.
Yeah. Drew Asher noted they ended the quarter with $437 million in available cash. But he also detailed a transaction where they took $1 billion of their 2025 Part D risk share receivables, sold them, and used the proceeds to immediately repurchase $1 billion in senior notes.
This is where we need to widen the lens and look at the broader macroeconomic environment to understand why this was so brilliant. First, let's define what a Part D risk share receivable actually is.
Okay.
Because of how the Medicare prescription drug program is legally structured, the federal government, CMS, frequently ends up owing Centene money at the end of the year to settle up the final cost sharing. It is essentially an ironclad IOU backed by the United States Treasury.
Centene knows they're going to get that money. Management noted the check usually arrives around October, so it's a guaranteed asset sitting on their books.
But an IOU doesn't help you today. In a high interest rate macroeconomic environment, cash today is exponentially more valuable than cash 6 months from now. So instead of waiting until October for the government to finally process the payment, Centene engaged in a financial strategy called factoring.
Right.
They took that $1 billion government IOU and sold it to a private financial institution. The bank buys the IOU at a very tiny discount. Maybe they pay Centene $990 million today for the right to collect the full $1 billion from the government in October.
So Centene takes a tiny haircut to get their hands on $1 billion in liquid cash instantly. And what did they do with that mountain of cash? They didn't issue a dividend or buy a new corporate jet.
No, they did.
They turned right around and executed a tender offer to buy back and retire $1 billion worth of their own senior notes, which is corporate debt, that was sitting on their balance sheet and generating interest expenses.
They executed a flawless arbitrage. They traded a non-interest-bearing asset, the government IOU, for the immediate ability to extinguish high-interest corporate liabilities. That maneuver instantly dropped their overall debt-to-capital ratio down to 43.2%.
It's such a smart move.
Right. By retiring that debt early, they wipe out millions of dollars in future interest payments that they would have owed, which mechanically boosts their profitability for the rest of the year.
But it's more than just saving on interest. It is about clearing the runway for the future. An analyst on the call astutely pointed out that Centene has some massive corporate debt maturities looming on the horizon. They have $1.2 billion coming due in 2027 and another massive $2.3 billion wall of debt maturing in 2028.
And when a company hits a maturity wall, they usually have to refinance that debt. If interest rates are higher in 2028 than they were when the debt was originally issued, the company's borrowing costs skyrocket. But Centene generated a staggering $4.4 billion in operating cash flow this quarter alone. By utilizing that cash, combined with highly efficient maneuvers like factoring receivables to retire the 2025 debt early, they are telegraphing to the market that they have fortress-level financial flexibility.
Yeah.
They can manage those 2027 and 2028 maturity walls without breaking a sweat, insulating the company from broader credit market volatility.
That level of financial engineering requires an immense amount of predictive analytics. And that brings us to the final and perhaps most culturally relevant piece of management commentary. We have to talk about artificial intelligence.
Ah, yes, AI.
Every single CEO on Wall Street is legally required to say AI 3 times on an earnings call right now, but usually it's just hype. They bought a subscription to ChatGPT to write marketing emails. Centene, however, is deploying AI deep in the trenches of their medical economics.
This is where we are seeing the transition from generative AI novelties to structural systemic advantage. Management detailed how they are deploying advanced proprietary machine learning models across their forecasting and payment integrity divisions. They describe this AI architecture as an independent validation layer that runs in parallel with their traditional human actuaries.
Let's visualize how that works in the real world. You have a team of highly trained human actuaries sitting in a room, analyzing historical spreadsheets, trying to forecast exactly how much asthma medication the Medicaid population in Ohio will consume next winter.
Okay.
But right beside them, operating at light speed, you have an AI model. This model isn't just looking at historical claims, it is digesting real-time billing data, correlating it with live weather patterns, socioeconomic shifts, and provider habits to generate its own entirely independent forecast.
It creates a system of highly sophisticated checks and balances. The AI brings a velocity of data synthesis that humans simply cannot match. It allows the management team to identify micro-trends in medical utilization weeks or months before they show up in a traditional quarterly report.
Right.
But the most immediate, tangible impact of this technology is occurring in payment integrity, which brings us back to the fraud crackdown we discussed earlier.
Right. Catching the therapist billing 28 hours a day. The AI is the ultimate bouncer at the door of the corporate treasury.
Exactly. Historically, fraud detection was often a pay and chase model. The insurance company would pay the bill, and 6 months later, an auditor would realize it was fraudulent and try to claw the money back, which is incredibly difficult.
Super difficult.
Centene's AI validation layer is auditing the claim in real time. Before the check is ever authorized, the algorithm cross-references the bill against billions of data points, flags a mathematical anomaly, and hard stops the payment.
It fundamentally changes the efficiency of their human workforce. Instead of paying hundreds of investigators to manually sift through haystacks of data looking for a needle, the AI just hands the investigator the needle and says, "Here, go prosecute this clinic."
It is a profound structural advantage that will only compound over time as the algorithms consume more data and become more precise.
Yep.
So, after dissecting this massive, complex quarter, wading through HBRs, Medicaid unwinding, the golden rule of risk pools, factored receivables, and algorithmic fraud detection, what does this all mean for the person listening to this right now? It's time to distill this masterclass down to the bottom line. We have 3 definitive, actionable takeaways from Centene's Q1 report.
Takeaway number 1. The massive 50-cent earnings beat was a product of rigorous operational discipline, not just macro-environmental luck. While a light flu season provided a helpful tailwind, the fundamental driver of their Medicaid margin restoration was permanent structural upgrades. Standardizing utilization management across 30 states and deploying AI to aggressively halt fraud, waste, and abuse are systemic enhancements that will protect margins for years to come. Furthermore, state governments are acting rationally, updating their rate payments to match these underlying cost trends.
Takeaway number 2. There is a massive hidden upside catalyst waiting in the commercial marketplace segment. Management is currently operating with extreme conservatism, embedding only a 3% margin in their guidance. But the early independent weekly data strongly indicates that Centene captured a higher acuity, sicker population during the market transition.
Yeah.
The mechanical rules of the ACA dictate that they are owed a substantial risk transfer payment from their competitors. If the finalized June data confirms this dynamic, investors should anticipate another significant guidance raise in the back half of the year as that revenue is officially recognized.
And takeaway number 3. The Medicare segment is currently navigating an industry-wide crisis regarding specialty drug costs triggered by the Inflation Reduction Act's out-of-pocket caps. However, Centene anticipated this turbulence, priced their models conservatively, and actually outperformed their internal worst-case scenarios for Q1.
Which is key.
More importantly, they have a defined strategy to return to profitability by 2027 through repricing their bids to force higher government subsidies, while simultaneously deploying total cost of care models to fundamentally alter how high-end specialties like oncology are managed.
Which brings us to the Talk Ticker's definitive stance on Centene Corporation. Based on the data, the operational upgrades, and the management psychology displayed on this call, we are strongly bullish. And the primary anchor for that bullishness is our belief that Sarah London and her executive team are deliberately, aggressively sandbagging their own guidance.
The math strongly supports that thesis. They beat expectations by a staggering 50 cents in the first quarter, yet they only raised their full-year guidance by 40 cents. They are intentionally building a massive layer of cushion into their public models.
Yeah.
When analysts pressed them, they openly admitted they have not factored in the upside of the weekly risk adjustment data, and they explicitly stated they are assuming zero continued outperformance in their Medicare segment for the rest of the year. Despite the fact that the tools driving that outperformance, like the AI payment integrity, are still running at full capacity.
They are setting an incredibly low bar for themselves to step over in the coming quarters. For a retail investor holding CNC, the narrative is clear. The multi-year operational turnaround engineered by this leadership team is no longer a theoretical promise. It is genuinely bearing fruit in the hard numbers. The actionable advice is to hold the position, but you have to keep a very close eye on the calendar.
The cadence of the year is critical here. Investors must watch Q3 and Q4 seasonality. Historically, the managed care industry experiences higher HBRs and occasionally post-losses in the fourth quarter.
Right.
This is driven by consumer behavior. Patients rush to schedule elective surgeries and fill prescriptions at the end of the year before their annual deductibles reset in January. Management has factored this historical headwind into their conservative guidance, but an investor needs to be mentally prepared for those optics.
Good point.
And most importantly, circle June on your calendar. The release of the finalized weekly data is the primary explosive catalyst that could unlock that sandbagged marketplace upside.
This has been an incredibly dense journey through the mechanics of corporate healthcare. But before we officially wrap up this deep dive, I know you always have one last conceptual thread rolling around in your head that didn't make the headline analysis. What is the final provocative thought you want to leave our listeners with today?
So this deep dive into Centene's technology raises an incredible, almost science fiction level question about the future of the industry. We just spent a significant amount of time praising Centene for deploying highly advanced AI algorithms to act as a defensive shield.
Yeah, you did.
Their AI is analyzing millions of data points to identify excess use, audit claims in real time, and catch mathematically impossible billing patterns before the money leaves the corporate treasury. It is a brilliant, necessary cost containment strategy.
Right, the AI validation layer. It's the ultimate auditor.
Exactly. But if we pull back and look at the entire healthcare ecosystem, Centene is only one side of the battlefield. They are the payer. On the exact opposite side of that transaction, you have the providers, the massive hospital systems, the private equity-backed clinics, the specialty practices.
Oh, wow. I see where you're going with this.
And you better believe that those incredibly well-funded provider networks are actively developing and deploying their own highly advanced proprietary AI systems. But the provider's AI isn't designed to reduce costs. It is designed to maximize billing. It is designed to instantly read a patient's medical chart, cross-reference it against thousands of obscure insurance rules, and extract every single possible diagnosis code to ensure the hospital extracts the absolute maximum allowable dollar amount from the insurance company.
Whoa. So you're looking at a scenario where an AI specifically trained to scrutinize, challenge, and deny claims is going head-to-head against an AI specifically trained to optimize, inflate, and maximize those exact same claims.
Precisely. We are rapidly approaching an automated, algorithmic algorithmic arms race between the payers and the providers. You are going to have two incredibly sophisticated supercomputers battling each other in milliseconds over the validity of every single medical bill generated in America.
That's intense.
And the question that every healthcare investor needs to be pondering right now is, how will that unseen digital war actually reshape the physical delivery of human healthcare? Will two opposing AIs eventually reach a state of perfect, frictionless efficiency, or will they just create a paralyzing systemic gridlock of automated infinite appeals and instantaneous denials, leaving the human patient trapped in the middle? It is a systemic risk and an evolutionary leap that is going to define the next decade of this sector.
That is a simultaneously terrifying and deeply fascinating concept to chew on. And it perfectly brings us full circle back to where we started this conversation. The financial health of these massive corporations isn't just a murky, unreadable spreadsheet anymore. It is becoming a highly complex, data-driven diagnostic scan generated by algorithms, and we as investors are just now learning how to read the output. Thank you for joining us for this incredibly deep data-forward masterclass on Centene's Q1. Remember to stay curious, never settle for the headline numbers, and always keep diving deep into the mechanics of your investments.